Hello, and welcome to Taxes in 10, where we take a tax topic and break it down in about 10 minutes. My name is Mark Barnes, and I'm the Education Director at Potential CPE. This episode is on Qualified Domestic Relations Orders, also known as QDRO. A QDRO is a legal order typically issued by a court in the United States to establish the division of retirement benefits such as 401ks, pension plans, and similar accounts between spouses as part of a divorce settlement or legal separation. A QDRO is a judgment, decree, or order that creates or recognizes the existence of an alternate payee's right to receive all or a portion of the participant's benefits. An alternate payee is any spouse, former spouse, child, or other dependent of the participant who is recognized by the QDRO. A QDRO must specify the name and the last known mailing address of the participant and the name and mailing address of each alternate payee covered by the order, the amount or percentage of the participant's benefits to be paid by the plan to each alternate payee, the number of payments or periods to which the order applies, and each plan to which the order applies. Key points about QDROs include the purpose, the requirements, tax implications, and the division method. QDROs are designed to ensure that retirement benefits earned during a marriage are properly divided in the event of a divorce or legal separation. They help to safeguard the non-employee spouse's right to a share of the retirement benefits accumulated during the marriage. A QDRO must meet specific legal and procedural requirements to be valid. It should clearly state the names and addresses of the parties involved, the name of the retirement plan, the exact method of dividing the benefits, whether a specific dollar amount or percentage, and the timing of the division. Properly structured QDROs allow for the transfer of retirement assets between spouses without triggering immediate taxes or early withdrawal penalties. The receiving spouse takes on the tax liability when they withdraw funds from the account. QDROs can specify various methods for dividing retirement benefits, including dividing account balances at a specific point in time, distributing future benefit payments, or awarding a portion of the benefits upon retirement. A 401k could be split now, while a pension plan could be split over the life of the individuals. Let's look at an example. Jack and Diane are getting divorced. As part of the divorce decree, Diane is awarded $300,000 of Jack's 401k. After much discussion with her attorney, Diane has decided to go to college and would benefit from multiple distributions from the 401k to cover her costs during that time. The QDRO is structured in a way that Diane will receive 60 monthly payments of $5,000 each. The money remains in Jack's 401k plan, and Diane remains an alternate payee. Unlike other distributions from 401ks and qualified plans, QDRO distributions made prior to age 59 and a half aren't subject to the early withdrawal penalty of 10%. You can take a distribution pursuant to a QDRO without incurring a penalty, but regular income tax still applies. This exception is found in Internal Revenue Code 72T2C. Let's go through another example of how this works. Jack and Diane are getting divorced. As part of the divorce, Jack is awarded $250,000 from Diane's 401k. It is a one-time payment. Jack has decided to buy a Lamborghini since he will be back on the dating scene. The 401k administrator makes a check payable to Jack as an alternate payee from the 401k account. As long as the money is in Diane's 401k, Jack is an alternate payee, which is one of the requirements. The remainder of the money stays in Diane's 401k, and she continues to contribute and grow her retirement plan. Although he isn't subject to a 10% penalty, Jack ends up on an IRS payment plan because he forgot to factor regular income taxes with the new single filing status into his master plan. Now let's talk about a way to not do this. Years ago, I completed a tax return, and the client came in to pick it up. They were freaked out because they owed. We discussed the situation, and she insisted the balance due was wrong. She had a QDRO and should not have to pay the 10% early withdrawal penalty on her distribution. After much back and forth, she finally realized her mistake. Her QDRO was properly executed, and her money was rolled into an IRA as she had requested. Then she took a distribution from her IRA. She is no longer an alternate payee. It's her money, and so the 10% early withdrawal penalty applied to her. In the end, she said it was easier that way because she could withdraw whatever amount she wanted. She just thought the QDRO rules would still apply since it was his retirement money. Some lessons are learned the hard way. Make sure to hit the subscribe button to keep up to date on all of our Taxes in 10 video series. Please give us a like on Facebook at facebook.com/potentialcpe and Instagram at instagram.com/potentialcpe. If you are interested in earning continuing education on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4-hour on-demand webinars will focus approximately 75% of each hour educating theory and regulation and 25% of each hour on procedure with real-life examples to help you increase your potential.